So when you choose a business structure, there's a lot of different businesses you can choose to become. Sometimes you have to form the business legally with what they call estate filing. Because when you file your typical business structure, you do it in a state, in one of the 50 states. You don't do it with the federal government. You do it with one of the 50 states. The exception would be the sole proprietorship. This is the default for one person starting a business, waking up one day and say, I think I'm going to start walking people's dogs and charging them, and that's going to become my business. Well, if you don't file anything with the state, you're going to default to being a sole proprietorship. Because one owner, sole, proprietor means owner of a business, and you would fill out Schedule C. And beyond that, you really wouldn't have any other responsibilities of filings. That's the advantage, is that it's very easy to start. The problem is you're going to have what's called unlimited personal liability. As the owner of a sole proprietorship, since you didn't file with the state, you're going to have unlimited personal liability. That's the disadvantage of a sole proprietorship. That's the biggest disadvantage. Whereas if you would have filed some documents, you could have become an LLC, a single member LLC, and you still would have filed Schedule C, but now you would have had limited liability instead of unlimited liability because you let the state know your intentions and you filled out their template and they granted you an LLC, which really protects you from certain liability. It wouldn't protect you from fraud if you committed fraud. It wouldn't protect you from hurting someone if you physically harmed someone. But what it would protect you from would be debts of the organization, assuming there was no fraud. You wouldn't have to lose more than your own investment if you were a LLC. But if you never filed those LLC documents with the state, and it's usually just one page, if you never did it because you didn't know, or because maybe you thought you did it, or you thought someone else did it, but nobody did, then you default to being a sole proprietorship, and you have unlimited personal liability. Now, for every other purpose, you're a business. You could have employees as a sole proprietorship. You might have employees working for you. You might even trade under a fictitious name. You might come up with a clever business name and everybody knows you as that name. That's okay under a sole proprietorship or any other business. So you're much like other businesses, except that you have that disadvantage of the unlimited personal liability for business debts, which is never good to have. Believe it or not, most one-owner businesses in the U.S. are sole proprietorships, not because people want to have unlimited personal liability, but because people don't know better. They don't realize that they would have had to file a form in order to avoid that unlimited liability. Sometimes what happens is you start out as this sole proprietorship. Then when you get a little more successful and you need an accountant or you need a lawyer or you need somebody, they mention to you, hey, are you an LLC? And you're like, what's that? And that's when you kind of learn about this kind of thing. But in the beginning, you don't know. All you know is that you like walking dogs. So you start doing that, and people keep calling you and saying, hey, could you walk my dog on Saturday? And before you know it, you're walking a bunch of dogs, and you're making money. And that's the only thing you're thinking about. And then as you start making money and paying taxes, that's when most business owners either learn the rest or maybe they merge, they get to be a bigger company, they take on partners or whatever. So a sole proprietorship is much like another business. They could have employees, they could trade under a fictitious name, but that big disadvantage is always there, unlimited personal liability. The other disadvantage is that if you need to grow your sole proprietorship, your capital is limited to the funds that you have and the funds that you yourself can borrow, since there's no one else but you owning this company. So that's a disadvantage. And then the hobby rules apply. If the IRS questions your activity as a business, then you're going to have to prove that you really are a business. For example, with dog walking, that really wouldn't be the issue because you don't really have expenses as a dog walker, right? They hand you the leash, they hand you the pooch, you go out, right, and you do your thing. But some businesses, you actually have expenses, and those expenses tend to be greater than income, especially in the early years until you establish yourself. Now, the hobby rules are the IRS, if they think that what you're doing is just a hobby and not really a business, they won't let you write off the expenses and show a loss. They'll say, well, that cover band that you play in on weekends where you buy equipment for your band and you write off the travel expenses and everything else, that's really just a hobby, isn't it? You're not really in it to make money. Yeah, you have to be in it for business purposes. You have to show that you're in it to make money if they question you with the hobby rules. But if you can prove that you're a business, then you can show losses. But you have to prove that you're a business. So that's a sole proprietorship. There's lots of them out there, but our advice as a CPA would be to pretty much convince our client not to start a sole proprietorship, but instead to start an LLC. Because you could be a one-owner LLC, and it's really no different than a sole proprietorship other than the fact that you have limited liability instead of unlimited. Now, the taxation of it all would be the same. You would still fill out Schedule C. Whether you were a single member LLC or a sole proprietor, you're still using Schedule C. So there's really no difference in the taxes of a sole proprietor versus a single member LLC. There's no difference in the taxes. The difference is in the liability of the owner. So let's go to slide 2. Which of the following is true of a sole proprietorship? One says the sole proprietorship is a separate legal entity apart from its owner. That's false. Yeah, because it's really the owner and the business are one and the same, and that's where the unlimited liability comes in. Because whatever the business is liable for, the owner's liable for, since they're not a separate legal entity, because they never filed the document with the state. 2, sole proprietor is generally considered to be the simplest form of business structure. I got to agree with that. Yeah, I got to agree with that. Why? Because you don't have to file any documents. You just wake up one morning and say, hey, I'm in business. Yes, you're right. It's a very simple form since it's only one person. Right, how complicated could that be? You have a meeting with yourself, right, and decide what the next course of action is going to be for your company. So that's pretty simple. 3, the capital is limited to the funds that the sole proprietor has or can borrow. In a sole proprietorship, that's true. Yeah, your capital is very limited in a sole proprietorship. So if you're going into a capital-intensive business, the sole proprietorship is probably not the best structure because you're going to need money in a capital-intensive business, and you're going to need to borrow money or rely on your deep pockets. So the answer is 2 and 3 is correct, which is letter B. All right, how about this one? Which of the following is true regarding a sole proprietorship? Yeah, number 1 is out, right? Sole proprietorship, that's a advantage for an LLC, limited liability. A sole proprietorship has unlimited liability, and it's a disadvantage, not an advantage. So go to 2. False. Number 2 is false because the federal government doesn't require you to file anything when you start a business, whether it's an LLC, a sole proprietorship, partnership, or even a corporation. It's the state that might require you to file something. So federal government, you don't really start your business with the federal government. The only thing you're really going to have to let the federal government know about your business is once a year you're going to have to file a tax return. And that's how the federal government keeps track of your business. Other than that, It's the state that really regulates your business. So the answer is both of these are wrong, right? Which is D. All right, so which of the following is correct regarding a sole proprietorship? A calendar year taxpayer, what does that mean? December 31st, your year ends. If you own a sole proprietorship, you must operate your sole proprietorship on a calendar year basis. That's true. That's true. That'll be true with a partnership also. If you're a calendar year taxpayer and you have other calendar year taxpayers, you're going to have a calendar year partnership. 2, a taxpayer who owns a sole proprietorship files Schedule C and the net profit is subject to the self-employment tax. Yeah, because that's how the self-employed pays their Social Security tax, based on the net profit from the business. So both of these are correct, half of which is deductible to arrive at AGI. Yep. On the CPA exam, when you see the term partnership, I want you to think of what's called a general partnership. General meaning default. So this is going to be similar to what we saw with the sole proprietorship. If you want to be a partnership but you don't file any formal documents, you're going to default to being a general partnership. Look at the last bullet here on slide 11. The default is the general partnership status unless you file a formal document with the state, which would make you like a limited partnership or a limited liability partnership or maybe an LLC, depending on which document you file. Some rules apply to all partnerships, and some apply based on whether it's a general partnership or not a general partnership. And the most obvious being the liability of the partners. Whereas if you're a partner in a general partnership, you're going to have that same unlimited liability that a sole proprietor has, all because you didn't file your documents. So if you're a partner in a general partnership, you have unlimited personal liability, just like the sole proprietor has. So the definition of a partnership is 2 or more persons who carry on as a co-owner of a business for profit. And the for profit is very important. If you want to be considered a partnership, you've got to establish that you have a profit motive. Otherwise, if the exam asks which of the following individuals are forming a partnership, and you see that there's a couple of friends getting together to exchange video game secrets, but they're not in it to make money, profits, they might meet every week. They might share certain things. Maybe they share costs of the game or whatever. But if they're not looking to make a profit, it's not a partnership. Doesn't mean that they're making money. They might be losing money, but at least they have a profit motive. You have to have a way that you'd be potentially earning revenue, and you have to be doing that with a profit motive. If so, then you are a partnership, maybe by a formal agreement or even an informal agreement, possibly no agreement at all. You could be considered a partnership as long as there's a profit motive. Do you have to have a formal agreement? No, you don't. In fact, most partnerships do not have any agreement. It's crazy. It doesn't make a lot of sense because you could get sued and get into big trouble, and then you'll wish you had a formal agreement. But most partnerships start the same way that sole proprietorships start. Somebody wakes up one morning and says, I'm going to start walking dogs, right? That's how the sole proprietorship started. Well, the partnerships, they tend to start the same way. 2 dog walkers bump into each other in the street and they say, hey, let's do this as a team. We'll start a partnership. This way, when I can't do it, I'll call you and you'll do it, and vice versa. So now they just started a partnership, but do they have anything in writing? No. And the problem with not having it in writing is that the court is going to determine that they're equal partners, even if that wasn't their intention. So if there's some type of a lawsuit, the judge will ask for the formal agreement. And if there is no formal agreement, the judge will say, well, it looks like you're equal partners now, because if you don't have a formal agreement, that's what you are, equal. Yeah, but I do all the work and that one doesn't. Doesn't matter. Yeah, but I put up all the money. This one didn't put. Doesn't matter. If you don't have a written agreement, the judge will determine that you're equal partners. So general partnerships start usually often without an agreement, but it's risky. Well, you need the agreement with the other partner so that you know who gets what percentage of, let's say, the profits. That's what the formal agreement is for with each other, is to establish with each other, hey, if you're 60% and I'm 40%, let's get that in writing. If I'm 70% and you're 30%, I'm going to want that in writing, because if we wind up in court, the judge isn't going to know what we thought ahead of time unless we put it down in the formal agreement. As far as liability goes, we both have unlimited liability if we're general partners. In order to have less than that, in order to have limited liability, we would have to file the formal document with the state. Now, this has nothing to do with our agreement with each other, but we'd have to file on a template whatever the state requires a partnership or a limited liability partnership to file. And if we don't file it, then we default to being a general partnership, and the disadvantage there is that we have unlimited personal liability. So the liability, once again, comes from filing with the state or not filing with the state. That's different than going to court and trying to argue that you have a better claim to the profits than the other guy. So you might need two formal agreements, one with the state and one with each other. The one with the state establishes that you have limited liability, limited personal liability. The one with each other is just, you put that away in case you need that in court one day. Now, the partnership files a tax return in the middle of slide 11. The partnership files a tax return, a separate return, but pays no tax on that tax return. So while a partnership files a tax return, it pays no tax on the partnership tax return. This is the big thing. Put a star here. So if you and I are partners, whether we're 50-50, 60-40, 70-30, a partnership tax return will need to be filed for us. And on that partnership tax return, even if we made $1 million profit, no income tax would be paid with the filing of that partnership return. Why not? So make a note that says all the income and loss passes through from the partnership return to the individual returns of the partners. So there's a link that connects the partnership return to the individual returns of the partners, and that link is called a Schedule K and a Schedule K1, and those schedules are attached to the partnership return to show the IRS exactly who's responsible for picking up how much income from this partnership. Because as we said, the partnership isn't going to pick up any of the income and pay any of the tax, but somebody's got to pay the tax. And the good question, why is there a K and a K1? Well, the K is a summary and has a total of everything. The K will say, here's the total income for the year, $1 million. And then the K1, each partner will get a K1. And yours, if you're a 30% partner, will show that you're responsible for $300,000 of profit. You got to pay tax on that. And I'm responsible for $700,000 of profit. I got to pay tax on that. That's the K1. We each get a K1, and there's one Schedule K. It's like the master. Schedule K is the master. Everything has to sum to the Schedule K, because there might be other items on the K1. There might be interest and dividends that pass through to the partners from the partnership, and all those totals will be on Schedule K and broken out separately on your K1 and mine to show how much we're responsible for. So some more things about the Uniform Partnership Act that governs partnerships. We said that everybody's going to be equal if there's no formal agreement. We said that if it's a general partnership, because they never filed any documents, everyone has unlimited personal liability, much like a sole proprietor. The default entity would be the general partnership status unless a formal filing is made with the state. The formal filing You could make yourself a limited partnership, an LP, which is kind of old and outdated, or an LLP, which is more modern and more protection for the owner, a limited liability partnership. But to do it, you'd have to file some type of document with the state. Otherwise, you default to a general partnership. And then that agreement you have with each other, that doesn't get filed with the state. You just keep that aside so that if you need that in court, you have it. Now, on slide 12, in most states, what governs the operation of partnerships when there's no express agreement? Yeah, the UPA, the Uniform Partnership Act, is like the AICPA of partnership law. So the Uniform Partnership Act will tell you that everybody's equal if you don't have a if you don't have a filing with each other. And the UPA will tell you that if you don't file with the state, you're going to have unlimited personal liability. Now, on slide 14, does the partnership agreement have to be in writing? The answer is only if it's impossible to complete the partnership purpose within 1 year, then it has to be in writing. Otherwise, if it's just two guys meet on the street who are walking dogs and they agree to be partners, doesn't mean it's impossible to complete it within 1 year. How long is it going to last? Doesn't matter. It's considered a partnership at will, and it doesn't have to be in writing. But what if it says A and B wish to be partners for the next 6 years? Well, now you know that it's impossible to complete that within a year, so that agreement would have to be in writing to be enforceable, because then they're going to split all profits, it says, and assets after the 6th year, and then they're going to return to their solo careers. Well, since this agreement is impossible to complete within 1 year, then it would need to be in writing. Then it would need to be signed by whoever you expect to perform. But it's different, because if they just meet on the street, or if they meet and agree to be partners without specifying a term, then their partnership is at will, and then it doesn't have to be in writing. Just because it lasts for 6 years or 60 years doesn't mean that it has to be in writing. It only has to be in writing if you know at the beginning that it's impossible to complete it within a year, then it would have to be in writing. If it just so happens to last longer than a year, that doesn't mean that it had to be in writing. So go to 15. Doug and Dallas enter into a partnership agreement to sell gourmet dog biscuits. They fail, however, to specify how long the partnership will last. So they're going to start doing business together without saying how long it's going to last. So Doug and Dallas enter into a partnership agreement to sell gourmet dog biscuits. They fail to specify how long the partnership will last. So first of all, we know if they don't have anything in writing, they didn't file anything with the state either, it says, so they're a general partnership, and they're a partnership at will because they don't indicate with each other how long it's going to last. So the answer is D, where yes, it is a partnership, but it's a partnership at will. Does it have to be in writing? No. What if it lasted for 5 years? Doesn't matter, because they never specified how long it was going to last, so it didn't have to be in writing. It would only have to be in writing if you specify how long you want to be partners with someone in advance. Then you got to put it in writing. If it's impossible to complete that partnership within a year from the onset, then you have to put it in writing so everybody knows exactly when this is going to end. This question asks, what is a disadvantage? It didn't ask which of the following is true about a partnership. It says which of the following is a disadvantage of a partnership. And you got to watch those kind of questions the way they're worded. Because something might be true, but it might not be a disadvantage. So you got to watch the way the question's worded. It's asking for a disadvantage. One says the partnership itself pays no taxes. That's true. That's not necessarily a disadvantage, though. Rather, each partner's profits from the partnership are taxed as individual income to that partner. That's true, but that's not necessarily a disadvantage. So one is not right because of that, because they're looking for a disadvantage in this question of a partnership, general partnership. Two, partners are subject to personal liability for partnership obligations. That's true, and it's a disadvantage. So we're looking at B here for the answer. That's the main disadvantage of general partners, is the unlimited personal liability of the general partner. Hey, it's Darius. After you subscribe to my YouTube channel, go to CPAexamtutoring.com, contact me, click Ask Darius right here, and then contact me, and I'll put you on an exclusive list where you'll be able to get a special discount every time you buy something from CPAexamtutoring.com. Get yourself on I-75 and take it to your next pass.